So today's presentation is about interest. What is interest? Understanding of regular interest and compound interest, API versus APY. Today's workshop objective is what is an interest? What does interest mean to borrowers? Understanding of interest rates, compound interest, APR versus APY. So let's work on this now. So what is an interest for you guys? So interest rate is the amount a lender charges a borrower. So how much interest you pay, how much to pay in interest. So basically, the factors include the percentage rate, the amount of loan that you're going to borrow, and the length of the loan itself. As the second picture indicates that the interest rate is the amount a lender charges a borrower and is a percentage of a principal, the amount loaned. Here's the beautiful and simple example of an interest rate. The interest rate is basically the equation for the interest rate is interest rate equal principal times rate times time. So if you look at the bottom example, this gentleman loaned $100 for at 6% interest rate for 1 year. So now looking at the principal on the looking at the equation on the top, so we just plug it in the number for the 1 year. This gentleman will pay $6 interest. All right, what does interest mean to the borrower? So basically, like, let's say if you guys want to take a loan, what does interest mean for you guys? So therefore, if you look at the chart, don't be scared by it. The chart simply explains it for you. If your credit score is excellent, which is in range between 780 to 850, that means your interest rate is going to be much lower comparing if you have a worse or a bad credit score, which is below 520. So believe me, guys, when I say it, and I'm going to repeat myself throughout the workshop, and your credit score does play a huge role when you do take out a loan or any other financial products. So here's another example for it, guys. So let's compare bad credit versus excellent credit, and why is it important, and why I keep mentioning credit score is important for any type of a loan that you guys take. For example, let's look at a 30-year mortgage that an individual will take a $160,000 loan with a 30-year fixed mortgage. So if the gentleman or if this individual have a bad credit score, most likely their mortgage interest rate will be 9.5%. So in a 30-year period, this gentleman would be paying $259,000, which is a huge money on interest. And if this person has, let's say, an excellent credit, his interest rate might be 3.9%, which will be like what, $89,000 for 30-year mortgage. So guys, do the calculation. It's simple math. Which one do you rather want to pay, 89,000 or the 259,000? And most important one, or most famous one you can call it, is the auto loan rate. So now let's say a typical 5-year auto loan of $25,000. So let's say an individual wants to take out a $25,000 loan for 5 years. So now if the individual has a good credit score, most likely his interest rate is going to be 5.1%. So for in a 5-year loan, out of from $25,000, he'll be paying $3,375,000 for 5 years on interest. Rather, if he has a bad credit, then he's going to be paying $13,828,000, which will be like 18.9% interest rate. So guys, that's why keep track of your credit score, and it will definitely help you out in future whenever you want to take a loan out or use or take out any other financial products. All right. So now understanding of an interest rate. Interest rate, as I said, is not only for the loans, uh, in, uh, or not lending money from any financial institution. Interest rate can be involved in a transaction as well, such as car purchase, credit cards, and home mortgages as well. The simple interest are for a loan or a large purchase, such as we can say a furniture a purchase, like let's say a good furniture you're gonna get from any of the furniture store with what 2,500, which is 2,500. That is considered as a regular purchase or once lifetime purchase. And then large purchases would be once in a lifetime that you will like do it very, very often would be a home mortgage. So this would be considered like interest, a simple interest on a mortgage. So now let's do an activity, guys. An individual took a $20,000 loan for 4 years, and the interest rate is 8.99%. Can someone tell me what is the interest for 4 years? And also, how much is this person's monthly payment? So now we have Giselle online over here. So Giselle, can you tell us? It's okay, no problem.
Yes, hold on. I'm trying to. I
Okay,
don't
I'm
have the
sorry.
glasses.
Go
Okay.
ahead, please. Go ahead.
Okay. An individual took 20,000 for 4 years, right?
Mm-hmm.
The interest rate is 8.99.
Yes. So now can you tell me what is the interest for 4 years and what is this individual's monthly payment? If you're not, I can tell you it's fine. I'm here
I
to
need
help.
a calculator. So you tell me.
All right, I'll tell you. No problem. So the next slide will explain for you actually very simple term. So now let's say, let me show you the calculation for the interest. $20,000 loan. Every organization in the United States will definitely charge you an application fee of a 2%. That's about in this case $400. It varies out on the amount of loan, how much you're taking out on. So that percentage stays the same, but it adds up as your loan increases. So, the amount that you borrow, the application fee of a 2%, which is $400. So now, technically, your loan will be 20,400. The APR, which is the annual percentage rate, is 8.99%, and then you would multiply that by 4 years. So simply, you're gonna go 20,400 multiply by 8.99, and then you would definitely multiply it by 4, and then that's what be your 4-year interest, which would be $7,335.84. Now, as far as the monthly payment, it's slightly different. So what you're going to do is you're going to take your amount that you're going to borrow plus the application fee, add the total interest on it, which the total amount you're going to be owing is $27,735.84. And what you're going to do is you're going to divide that by 48 months, which is 4 years. And that will be $577.89 towards your monthly payment. To double check your work, all you would have to do is you'll take the monthly payment, multiply it by the months, which is 48, which will give you the total amount of 27,735.84. Is that clear enough for you, Giselle? You have any questions?
Yeah. You said okay. Let me rephrase a little bit. So the amount 20,000.
Yes.
The fee it's 2%.
Yes.
Amount of 2014. The appraisal is 8.99.
Yes.
Okay. So when the monthly payment, you divide it for the 48 months, right? Because
Yes.
it's 4 year. Okay, I got it.
So basically, for the monthly payment only, you would have to add up the interest plus the amount that you're going to borrow and plus the application fee. And then you would divide that total divided by the amount of length of the loan that you have. And that will give you a monthly payment. Cool. Compound interest rate. Compound interest rate in simple terms basically means interest on interest. So let me explain to you how does it work. Compound interest, also called interest on interest, is apply both on the principal and the accumulated interest made during previous period. I'll give you more examples to make it a lot clearer for you guys. So here you go. Compound interest frequency schedules for usually applied for financial instruments such as savings account and money market account, certificate of deposit, which in other words are CDs, series of bond, which is called the stock market as well, and then compound interest can be applied for loans and interest credit cards. So I'll explain for you in detail as well. So now here's an example of a simple compound interest, an individual. So now this person, actually we name him, his name is Sam. Sam invests $1,000 for 10 years and Sam decides to keep his money in his account. How does the compound interest rate works? So for the year one, you're going to get $1,000 multiplied by 10%, which is $100. So now you would include 1,000 plus 100, which will give you a balance of $1,100. That will be for the first year. So now Sam decided to keep his money in his account. So for the year two would be 1,100 times the 10% would be $110. And then if you add the second year interest plus the balance for the beginning of the year, that will give you what? 1,210. So you keep going for at least 10 years. And to give you a clear picture of a compound interest rate, this individual invested $5,000 on a CD, or maybe on I'm sorry, not a CD. Let's say a savings account, because right now the interest rate for a saving account is at least 1%. So this gentleman invested $5,000 on a savings account, and he didn't touch it, and he kept his money for at least 30 years. By the end of the 30 years, his interest got added on top of the interest. So from $5,000 in 30 years, he made $6,672.52. I know that is not a lot of money, to be honest with you guys, but guess what? It's a free money. Take advantage of that. Here we go. What is APR? And a lot of people asking me, what does APR stand for? Well, APR stands for annual percentage rate. Annual percentage rate is the total cost charged for borrowing money. For example, APR also includes fees and such as origination fee and lender's fee. For example, credit cards. If you think about it, credit cards, APR is only applied for carrying a monthly balance on a credit card. So for example, let's say if you spend like $3,000 and you make like $100 monthly payment, and then each month that you make a payment, basically like the APR would be monthly carrying out. So let's say like they will charge you let's say the next month they will charge you 18% on 2,900, and then it adds up until you pay off the balance. APR versus APY. APR, basically, its annual percentage rate, as I said, is the total amount of interest you pay on a loan account over a year. The factors of it is interest rate, fees, and the miscellaneous loan costs, such as a maintenance fee or whatnot and everything like that. And then the APY is the annual percentage yield, which is the total amount of interest you earn on a deposit account, such as savings account over a year or any CD account or money market account. And the factors of APY are interest rate and compound interest rate, which we have discovered previously. All right, so now here's an example of everyone that I can assure you that everyone ignores that, which you should not. This is an actually brochure from a credit card company that let's take a look at it together and let's read it together so we can have an understanding of what are we missing. So if you look at it, the annual percentage rate, the APR for a purchase is 6.90 to 17.90%. So that means when you open your account based on your credit score, after that your APR will be vary the market base on the prime rate. What does that mean? It really depends on your credit score. So if you have a good or excellent credit score, most likely your interest, your APR on a credit card would be 6.90%. But if you don't have a good credit score and if you have a bad credit score, guess what? Your interest rate is going to be 17.90%. Let's look at the other one. APR for transfer balance based on your credit score. So if you have a good credit score, if you have, like, let's say if you spend $3,000 and you pay monthly payment, the remaining balance, if you have a good credit score, guess what? The credit card company will charge you 6.9% instead of charging you 17.9% if you have a bad credit. Cash advance is basically it's something that you take money out of your credit card. Let's say if you do that and then they're like, this would be in a very like emergency circumstances that you might need cash on hand, that you want to use your credit card, not a debit card, guys. It's slightly different. Cash advance can be only taken out from a credit card. Your debit card is linked to your bank account, which that's a different situation. That's a normal withdrawal when you use an ATM or you go to the bank. But cash advance from a credit card can be done via a bank. If you have a bank credit card, you go and you ask for the person who works at the bank. Be like, I would like to have a cash advance for $3,000. If you have enough balance on your credit card, or if you have like your limit, your credit card limit is like $4,000, and then you can take out 3,000. But if you don't have your like if your credit card limit is like less than, like, let's say 1,500, then the bank will not give it to you. But that will apply if you have a credit card limit of at least large amount. But based on that, if you do take out cash advance from your credit card, guess what? If you have a good credit score, you're going to get the lowest rate. And if you have a bad credit score, you're going to get extremist worst rate. So think about it, guys. And then also at the very bottom, if you look at most credit cards, they do have an annual fee, but luckily this credit card does not have an annually, which you can see over here with my cursor is says none. And then transaction fee, let's say $5 for or 3% of the amount each transfer, and then $5 or 3% each amount cash advance. So basically, like, let's say if you do ask credit, like let's say Capital One, and you have a credit card and you want to do cash advance, the company will charge you 3% of the amount. And then there are late fees of $35, and then also return payment of $35 as well. Be careful with that, guys. And then also over the credit limit, none. Be careful, it says none, but in the small print says unless you have opt out. So be careful with that, guys. Read this brochure, or whenever you apply for a credit card, read it through and see if you understand anything. And if honestly, guys, if you don't understand, we are here to help you guys out. We are here as your financial coach. Call us, reach out to us, be like, hey, I don't understand it, and we would love to help you out. Annual percentage rate. Here's another an example of a CD account that you can invest, or you account that you would want to invest. So looking at that, 3 to 5 month CD rate is 0.5%. 6 to 11 month CD is 4.75%. With 12 to 23 month CD is 4.5%. So now looking at this, guys, Giselle, I will ask you this question. What do you think? Which CD account would you like to invest? and why?
Of course, the one that give me the more for my money.
Exactly. And which one would that be? Give me one of these terms.
Okay. Well, if I invest at 12 years, 10 to 12 years, I will have 1.50%, right?
Mm-hmm.
But you know what? I'll invest it in 3 to 4 years
3 or
first.
4 years. Okay.
Yeah.
So now here what if I tell you your best option is 6 to 11 month CD? You know why?
Oh,
Because
yeah, because it has more interest. Yeah.
exactly. So I would rather invest my money 6 to 11 month CD because I would get 4.75% interest rate on that. And that's my APY. Cool. Thank you, Giselle.
I agree with you. Thank you.
No problem. So now here's a question for you guys. If you have a high credit score, you'll get the lower interest rate for a loan or a credit card. Giselle, is that true or false?
Mm. Repeat that again.
True. It is true.
If you have a high credit, yes, that's
Exactly.
true. Yeah.
Absolutely. Thank you, Giselle. You do. It is true. If you have a high credit score and if you will get a lower interest rate on any loan or a credit card when you do apply. Here's a tricky question. So question number 2. If you pay more than your monthly payment, it does go towards principal balance. Is that true or false? It's actually false, guys.
It depends, right?
Yes, it is. At this point, it will not go towards your whatchamacallit, your monthly your principal amount unless there's a trick to it. So let's say your monthly bill is every third of the month, and you would like to make a large lump sum of money. The best way to do that is wait until your billing cycle is over, and then any large amount that you would like to throw at your loan, do it after the closing cycle monthly bill. This way, the company will charge you only interest per day instead of for the whole month. So let's say that you're making $400 monthly bill towards your car loan, and then the monthly interest on that is about what, let's say $80, and then if you make that large payment after the monthly closing period, then let's say 3 days after your monthly bill, then most likely the companies will definitely charge you, let's say, 3 days worth of the interest, and there could be any range between $5 to $10, and then the whole lump sum will go towards the principal amount. So therefore, in future, if you would like to make any large payment, wait until your monthly bill closes out, make it 3 to 5 days after your monthly billing, and then after that, whatever large lump sum you make, only that let's say if you have the 5th and you want to make the payment on the 10th, so the company will charge you only 5 days worth of the interest, which, as I said, it could be ranged between $5 to $10. And then if you pay your credit card balance before the due date, you don't pay interest. That is true. If you pay your credit card 2 days late, you will not have to pay a fee. That is false. That is 100% false. If you pay late, you pay penalty. If you pay late, you pay penalty. That is the simple calculation, simple math on that. Try to be on time. Any late payment, as we discussed in our credit class, any late payment can affect 35% of your credit score, guys. Don't do that, please. Pay it on time. If you forgetting about your monthly bill and you need to keep tracking of it, set up an automatic payment and let the company take it automatically out of your account. Just make sure you have a positive balance in your account. For any questions on what you learned today or other financial questions, contact a financial coach. Also, there are other useful workshops that are pre-recorded on our website, which is www.safeirc.org. Please visit our workshop, and there are a lot of useful information. Take advantage of that. Thank you so much for joining, and have a great evening.